through. And then I'm going to leave plenty of time for Q&A. And as we get down through this and get to the Q&A part, I'll put the chat room up, or the chat, whatever you call it, so that you guys can get your questions in and we can get those answered. So, yeah, let's see. Can I make this work? Look at that. Wow. All right. So, Q3, just to go over that real quick. The Dow Jones opened on July 1st at 44,061.49, closed at 46,397.89. On September 30th, was up 2,366.40 points, or 5.30%. And then, you guys can read the rest of this, but the S&P was up 8.10 and the NASDAQ was up 11.68. And then, oh yeah, we're recording this and I'm recording it to the cloud. And so I believe Elena is going to be able to put this on the website for anybody that wants to go back and wants to review any of these slides. Top performing Dow stocks. When I was putting this together, some of this kind of threw me for a loop. I wasn't really expecting it. But American Express, they signed a bunch of strategic sponsorships, primarily in the Miami area. I believe one was with Formula One Racing, one was with Miami Dolphins. Anyway, their earnings responded, and so it got bought up. Apple, don't need to talk about that. It's one of the Mag 7. Everyone knows about that. They did make a substantial domestic manufacturing commitment, and they have been providing guidance that they're continuing to progress in integrating AI into their products. This is one that really threw me. I had no idea. Was Caterpillar, because it's kind of sort of counterintuitive. And just real quick, everyone, make sure you mute your microphones right now, and so that we can keep the noise down. So yeah, Caterpillar kind of threw me for a loop. Didn't see that coming, because I mean that's a real gritty kind of industrial stock. Anyway, Home Depot, I know you guys own it. Positive consumer sentiment for major home improvement projects. Intel, oh boy, I know a few of you have emailed me about that. But Intel went up because of an equity stake by the U.S. government, which is kind of interesting. United Health. I mean, United Healthcare, clearly they got a big boost when we found out that Warren Buffett and Berkshire Hathaway made a major commitment and bought a huge chunk of the stock, which, if you go back and you look at the spreadsheet, and we can do that, and you can look at the internals of United Health, those were always fine. It's not that there was anything wrong with their return on invested capital or their cash flow or anything like that. Problem with United Health was the Department of Justice is looking at them for some issues. And that's why the stock just literally fell out of bed. Brother Buffett clearly doesn't think that's an issue because Berkshire went in and bought a bunch of it. So if the investigations by the DOJ turn out to be a nothing burger, then everyone who jumped in and bought United Health when they were way, way, way down in the yield to watch category, then yeah, you're going to be doing the Snoopy dance. S&P, I have no idea what App 11 does, but it did make it into the S&P 500. And not only did it make it in the S&P 500, it went up almost 100%. Now, I want you guys to kind of keep that figure in mind there for half a second. And actually, all of these, as we go through them. Corning, why did they go up? AI, data center build out. They have fiber optics. What were they up? 55.5%. Seagate Technology, data storage and AI related hardware up 55%. Warner Brothers Discovery, wow, the redheaded stepchild of media. Um, but apparently Paramount Skydance, which just took over Paramount, the parent of CBS, they seem to be hungry and more acquisitive. And I mean, this rumor is all over the street that they're going to be making a run at Warner Brothers, which is going to be kind of interesting. Since they already own CBS, this would give them CNN. Not sure how that's going to go over with the feds, but whatever. Anyway, they were up almost 65% in the third quarter. And then Western Digital, again, strong gains from demand in data storage and AI, up 76.5%. Now, at some point you have to be able to justify on a fundamental basis the price of a stock, its valuation. I don't know, like I said about AppLovin, I don't know who they are, what they do. S&P clearly knows something about them because they put them in the 500 index. I'm guessing it has something to do with tech. But if you go up 100% in a quarter over a 3-month period, I want you to stop and think about what actually drives the stock's price. It's cash flow, the return on investment in the company, their free cash flow. In other words, fundamentals. You know how long it takes for something to go up 100%? I mean, on like a natural, normal basis. I mean, you're talking about years. All right, they did it in 3 months, and so just in the back of your mind, I want you to keep some of these numbers in consideration and ask yourself: is this normal? Does this make sense? Okay. So moving on, top performing NASDAQ stocks. Guess what? Everything that was in the S&P plus, if you look at the bottom, surprise, surprise, Alphabet, which we know as Google, Apple again, and of course, NVIDIA. And it's interesting with NVIDIA in particular. I get asked about this often. People send me emails and leave messages on the system. And they ask me, Kelley, why aren't you looking at NVIDIA? And in a second, that's going to make sense to you here on a couple of other slides. But just kind of put this in perspective. To justify the current price today of NVIDIA, they're going to have to continue to grow at the rate of the GDP of a third world country, of a small country, forever. That's to justify fundamentally the valuation of that stock today. You want to know why we don't own NVIDIA? It's because that is insane. Those type of projections that this stock is going to continue to grow at that rate forever. And that's a mighty long time. Top performing sectors, geez.
Kelley, do you have
Yeah.
time for a quick question on AppLovin before you move on?
Yeah.
How much can be credited? What kind of increase in value could be credited to the fact that all the index fund managers have to buy it as soon as it hits the S&P index?
That's it. That's the point, is that everybody has to buy it.
That's what caused the 99%, you think? You don't think it's because they've got a better mousetrap now or something like that?
It could. I'm going to have to go take a look and find out who this company is and what they do. Like I said,
great.
I never heard of them. I have no idea that this could be the greatest thing since sliced bread. I don't know.
But it could be up that much just because the index funds managers all have to buy it, possibly.
Well, every time a stock gets added to an index, Yeah, you're always going to see a bump because yeah, every ETF that owns the S&P or the QQQ, they have to mimic in their ETF or in their fund what is in the index. And so,
Right.
yeah, they all go by and bada boom, bada bing, and then there you have it. So that's why when stocks get added to any of these indexes, you're going to see a bump.
I just
Um,
wasn't sure how much the bump could be. 100% is extraordinary if the bump
it's
just came from that.
it's wild. I mean that those numbers are just they don't make any sense to me. But anyway,
Thank you. Thank you.
yeah. Top performing sectors. Gee, here's a shocker: information technology. Um, Obviously, we're in the midst of a AI driven market, and that's powering tech and semiconductor stocks. This one kind of caught me by surprise because if you look at materials, if you look in our undervalued category, what do we have material wise? And I'm just thinking off the top of my head. Dow Chemical, which is in a world of hurt. Um, Eastman, which has been underperforming, I would say, definitely underperforming versus historically. What else is materials in the undervalued category? I'll have to go take a look in a second. But it didn't strike me that that would be one of the sectors that was performing well. But it also might be because people are anticipating the Fed cutting interest rates. So that might have something to do with it. Energy, very solid and consistent gains across nearly every major segment in the industry, in the energy sector. Communication services. So, communication services, you want to think of Omnicom. All right. Omnicom Group is probably the 800-pound gorilla in that sector. And they're buying one of their biggest rivals, which is the Interpublic group of companies, which is also an IQ Trend stock that we follow. Um, Omnicom was already huge. I mean, if you dig in and you really learn about the company, um, it's a real interesting business model. It's kind of an umbrella, and underneath this umbrella is over 1,000 little individual companies. I mean, they're all under the Omnicom umbrella, but each of these individual companies does their own thing. I mean, they have their own specialty, whether it's digital, whether it's print media, whether it's um, advertising, yada 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 yada. And then what's really interesting about this business model is that all those companies underneath the umbrella can and do compete against each other, for the same client. So one would think, gee, they're cannibalizing themselves, but they're not really. Um, so it's just a very well managed company, and now they're buying the Interpublic Group, and so the gorilla just went on steroids. They're going to be even bigger. So what were the major themes in the third quarter? Growth over value. I know you've never heard that before. Uh, AI infrastructure, of course, um, and supply concerns. So that's what ties into materials. Is that like things like the materials? They went out and started buying raw material for their chemicals, etc., because they were concerned about, and that's got to go back to tariffs. They're concerned about supply chain interruptions. All right. So I brought up rate cuts a minute ago. Everybody always asks about them, and you hear it all day long on the financial networks and you read it in the financial press. What a boom it's going to be to the market if the Fed reduces rates. Um, I'm not sure when that got melded into the mindset of the investment community. um, But it did, and as someone famously said, perception is reality. And if you hear something enough times, long enough, you start to believe it, whether it's true. Something gets repeated over and over and over. You go, oh, well, then it must be true. Um, and I didn't want to spend an hour and a half on this, and because we could have really dove into this really, really in depth and got really geeky about it. Um, but cash, as I wrote here, Federal Reserve notes, does not turn into something else. I keep hearing on the financial networks that there is all of this cash that is sitting on the sidelines just waiting to come into the market. There is no sidelines. Cash is not waiting to turn into something, because if you buy an asset with your cash, whoever sold that asset to you now holds the cash. It doesn't go away. Cash does not turn into something else um, until the Fed retires it, meaning that they take it off of their balance sheet. So there is no cash sitting on the sidelines. There may be people that have cash in their portfolios. Maybe they have cash, oriented money markets, what have you. And if they choose to put that into another asset, it's just going to change hands from the buyer to the seller. It's not going to go away. All right. So, um, earnings and profits, two different things. Earnings is an accounting convention. All right. Profit is a tangible asset. One is a figure on the balance sheet, the other one is an asset that you can spend or you can reinvest. Um, Stock valuations are at the most extreme level in history. If you want to, I can point you to some um, areas where, I mean, they're extremely, extremely geeky stuff, a lot of math, but it can show you, what the underlying mathematical reason is that valuations are at the most extreme level in history. But the bottom line is this: until the Fed reduces their balance sheet, there is going to be excess reserves. Um, and as long as there's excess reserves, you're going to have them changing from one hand to another, but they're not going to go away. So if I sell you something, you have the asset that I used to have, and now I have your cash. I'm sitting there with your cash. What am I going to do with it? Okay. Well, I'm perhaps going to go buy something else. And then someone else is going to hold the cash. So reducing interest rates, it's not going to do anything to change that equation. And that equation is really, really, really central to what's happening in the market. Um, they're right after the financial crisis, the Fed pulled in all of these interest bearing treasuries and other debt instruments, and they replaced them with zero interest debt interest, debt assets, which nobody wanted to hold because they weren't getting a return on it. And so it forced them into the stock market. And a lot of them were never comfortable because they had never invested in the stock market. They were used to getting their CDs and their T-bills and their T-bonds and their corporate bonds and muni bonds and just clipping the coupons every 6 months, what have you, and living off of the interest. Now it forced them into the market and for them to get a return. So um, the amount of zero interest assets that the Fed pushed into the system throughout history had always kind of been in like the 6% range. At the peak, it got up to 34%. Absolutely insanity, just nuts. Now, it's since come down to where those are only like 22%, but the point is the Fed still has this super bloated balance sheet. Um, and for equilibrium to return to the market, meaning where you have a normal yield curve and the cost of money, goes back to its historical pattern, um, the Fed's going to have to reduce their balance sheet by about 60%. Okay. So dropping Fed fund rates a quarter a point, a half a point, 2 points, that's not going to do anything to address any of this, because this is the issue and this is the problem. So I just, I don't want everyone to get caught up in the cash is on the sidelines thing, and that reducing Fed funds is going to be this phenomenal thing that's going to take the already most extreme valuation level in history to an even more level of extreme. So, and when you do purchase um, the market at its current valuation level, what most people don't understand is that you're locking in significantly lower future returns. And like I said, it's just math. If you guys ever really, want to see this stuff, I can give you the links and let you go and let your eyes cross, and you know, and maybe it'll cure your insomnia. So anyway, so uh, it came to my attention that years and years and years ago, and I completely forgot about it. I used to have this piece that Geraldine wrote in every issue of the newsletter. And for some reason, I don't remember why. It's probably because people got so familiar with it, they stopped paying attention to it. But as she wrote, the IQ Trends Register of Select Blue Chips is an elite representation of the highest quality and most prosperous corporations in the country. And according to our method, a stock will achieve the designation of select blue chip after it has met at least 5 of these 6 following qualifications and may remain with 4. So those of you who've been with us for a long time, I'm sure are familiar with this. 1 in 6 dividends increases and earnings improvement. Number 2, the S&P quality ranking, and I know that sometimes there's confusion about it, but per the orthodoxy from Geraldine, you need an A initially to get in, and you can stay in with an A minus or a B plus. It's when you drop below a B plus that we move to the fate of blue chips. Number 3 is really not that important anymore, but it was in 1966. But 5 million shares was a lot in 1966. It's not anymore. Um, but what number 3 is addressing is liquidity. And that's what we want. Is we don't want to have to make an appointment to buy or sell a stock. If we want to buy it, we want to be able to get it. If we want to sell it, we want to be able to sell it. And there's nothing more frustrating than being in a stock that doesn't have a large float, where you can't get into it or get out of it. It makes you crazy. Number 4, 80 institutional investors. This is not really that hard to do anymore, because there's so many sell side analysts that, I mean, it's incredible. But her point, and the point here, is that you want institutions to be interested in the stocks that you follow, because institutions have the heft to come in and take something and move it from undervalue into the rising trends, and on to its on towards overvalue. Number 5 is where the rubber really meets the road, at least 25 years of uninterrupted dividends. People ask me, is there a difference between 10 years, 15, 20 years? Yeah, there is. There is, because 25 years, you're pretty much going to see everything that's happening on a economic basis, on a geopolitical basis. You're going to have bull markets, you're going to have bear markets, you're going to have expansion, you're going to have recession. I mean, the whole nine yards, black swans, global pandemics, what have you. And so if you can keep your company relevant, its products and services that consumers still want to pay for, um, and you can manage to pay your dividend and increase it over that time period through all of those things, but more importantly, that you can attract, train, and retain the next generation of management that's going to continue the policies of this company that keeps it in this rarefied area. Yeah, that's a big deal. That's a really big deal. So, in the previous slide, Geraldine wrote that this is an elite representation. I wrote about this in the last newsletter, and it's partially because a longtime subscriber, Keith Howard, who I'm going to show you some of his slides in a minute, and he was gracious enough to allow me to use them, reminded me of this, and so I put it in the last newsletter. There's approximately 4,300 publicly traded stocks on the U.S. market. Currently, only 297 of those meet the minimum requirements for select blue chips. That's about 6.90% of the market. Of the 297 in the last issue, only 89 were in the undervalued category. That equates to 2% of the market that we're looking at. So our and I did that wrong. It should have been 89 divided by 4,300. I'm sorry. Point is, what we're looking at, where our investment considerations are, is about 2% of the overall market. So 98% of the market we don't care about because it doesn't meet our quality parameters. 2% of a giant market is much easier to keep track of and understand and know about than 4,300 companies. I mean, that's ridiculous. I saw a quote from the guy that ran the Fidelity Magellan Fund way back in the day. God, now his name is slipping my mind. I can't believe it.
Lynch, Peter Lynch.
Lynch. Yeah, how could I forget that? Anyway, yeah. He was giving an interview to someone, and they were asking him about his performance back in the day and how it was always so consistent and everything. And he said you have to know what you own and know everything about it. And I think that dovetails into what we do. We don't look at everything. We just look at what meets our criteria, and then we try to know everything we can about them. Undervalued, obviously the buying area. Overvalued is the selling area. Very simple. Rising trends is the hold. Declining trends is the ignore. Historically, 80%, so it's kind of between 70 and 80% of our universe when it's in the undervalued category. That has been coincident with major market bottoms. About 17, when our undervalued category is 17% or less, it's been coincident with major market tops. It doesn't mean that the market's going to bottom there or the market's going to top there, but coincidentally, that's happened many times over history. The big capital G, that is a stock that has increased their dividend at least 10% a year for the last 12 consecutive years. A small g means that they've increased their dividend at least 10% a year over the last 12 years, but they have not in the 3 and 5 year areas. So what does that tell us? It tells us that 8, 9, 10, 11, 12 years ago, they were increasing their dividend a lot. In the near term years, they're not increasing it as much. But what does that tell us? Maybe they're investing in new opportunities. Maybe they're building more factories. Maybe they're designing more products. Maybe they're hiring more people, or that they're maturing and they're slowing down, and that their cash flow is not what it used to be back in the day. And so their dividend increases have gotten smaller. Keith put together this slide, and I was looking at it, and I said, God, this is great. Why didn't I ever think about this? Because it's very simple. It shows the dividend life cycle, and how things move, price and yield, why something's undervalued, why it's overvalued. It's a very simple visual, very simple graphic, but it's absolutely positively spot on. And I appreciate Keith sharing it with me. I just wish that I had thought of it. But this is it. This is the cycle. This is the seasons. This is the pattern. Undervalued to the rising trend, to overvalued to declining trend, rinse, repeat over and over and over. So for those of you who've been with me for a very long time, I apologize. I know some of this is old hat, but I just wanted to make sure that we got some of the fundamentals in, because I was very gratified to see there was a lot of new subscribers that had signed up. And so some of this stuff may be new information for them. And I wanted to get that in. So if there's a question that I get asked more than any, it's about the timely 10. And I never intended for the timely 10 to be a standalone portfolio. That was never what I was trying to do. As everyone knows, or most of you know, we have a separate company that's a registered investment advisor. And so for years I had readers asking me, well, Kelley, how do you go through the newsletter? How do you pick stocks? Not only for my own account, but for other accounts. And I said, okay, well, let me show you how I do it. And so that was the catalyst for the timely 10. And it was to give you guys ideas to take a look and see, oh, here's a company, it's in XYZ sector. I've got a blank spot in my portfolio. This would work really well. Okay. Or it was just to show you the process. Okay. And it is a process because even though we only cover 297 stocks and only between 85 and 90 of them are in the undervalued area, that's still too many stocks. You can't hold them all. So how do you go about choosing between them? So this is basically the process, for the timely 10. And some of this stuff I don't write about all the time. So you might not be that familiar with it. Like we have a risk and reward rating, okay, up in here. 1 is attractive, 2 or very attractive, 2 is attractive, and 3 is a neutral or a hold. In order to be a 1, the stock's got to be in the top quintile, the top 20% of economic earnings versus reported earnings, return on invested capital, and this is old. It's not price to value ratio. It's price divided by economic book value. A 2 is the second quintile in the second 20%, and a 3 is in the third quintile. The 1s and 2s are the deepest values. So as data becomes available between issues, it's incorporated in the system, and stocks move up and down, the list according to changes in the data. And then so when I get to publishing day, I take the top 10 out of there. And I can't really think of an instance when I had any threes in there. The timely 10 has always consisted of ones and twos, what we would call ones and twos. Um, and if I didn't have 10 ones and twos, as some of you will know, we've had an elite eight or a super seven. Okay. I drop them off. I don't want to put anything into that, into this area that's not in that top one or two categories. So that's the process. That's how it works, and that's what we do. Um, so Keith, to his credit, did something I've never really had time to do or had an inclination to do. Um, but he created this. And if you look at our literature and what I've written over the years, the timely 10 still adheres to our philosophy, which is you buy something in the undervalued area, you hold it through its rising trend, and then you sell it at overvalue. Um, and because I don't keep my own statistics, um, except for the lucky 13, um, I wasn't really aware of how the timely 10 was doing. Now, Mark Holbert does track it, but um, he does something a little different. So he records a purchase when a stock appears in the timely 10. But when it gets taken out of the timely 10, either because it's moved into a rising trend or something else moved up in the rankings, um, in our philosophy, we would continue to hold it. But Mark doesn't. He disposes disposes of it. So he buys the timely 10, but as soon as it's no longer in the timely 10, he doesn't track it anymore. So Keith, to his credit, God bless him, um, he went back and he pulled every single issue of IQ Trend since the mid-August 2006 issue and put together a pro forma on the timely 10. Uh, and he did it because he wanted to capture the entire, lifespan of something. And so, as you can see here at the bottom, he literally took each report, 441 reports, um, and examined any information that impacted the timely 10. Uh, and then Keith is an engineer. You can tell by the detail. But he also teaches investing classes. And so, he always defines and lists his work and what he did and how he did it so it can be replicated, a true scientist. So since the mid-August 2006 issue, when I unveiled the timely 10, um, he went and he bought each stock, put $1,000 into each of them. Only once. If it reappeared, he didn't buy it again. Um, he used the price that was within investment quality trends. This was always done on the 1st and 15th of each month when we publish. And then dividends were recorded at the end of the quarter for any securities held in the portfolio at that time. Once again, tremendous detail. Proceeds from sales and dividends were either added to cash or to offset the purchase of new securities. Any excess cash was withdrawn. Sales were recorded prior to quarterly dividends. Overvalued stocks were sold. Faded blue stocks were sold. Stock splits or stock dividends were added to shares at the beginning of each quarter. Stock spinoffs were treated as if the spinoff securities were sold and proceeds reinvested in the underlying originating company. Taxes, commissions, inflation, and diversification were ignored. In other words, he was extremely clear, very clean. I was really when he sent this to me and I was looking at it, I was like, "Damn, this is amazing detail." And I love the way that the scientific mind works and how it shows the thinking process. And so he continued. Each year he began with FMV means fair market value. Um, if cash was required, he added it to the basis. And then the cash from sales or dividends were received, he deducted it from the basis. And at the end of the year, the fair market value of the portfolio was determined. And once again, in keeping with our publishing schedule, he recorded each transaction on the 1st or 15th of every month. And that's to keep it clean because that's how we publish. That's the data as you all get it. And so, he didn't make stuff up. He didn't go look, and find it anywhere else. He just took it right out of the newsletter. And then he put all of this stuff into Microsoft Excel and generated the internal rate of return. And this was to find out what the annual return on investment was. So, just as an encapsulation, he had an initial investment of $52,000. There was $46,000 of dividends, which is kind of wild. The dividends almost, but I'm not really shocked at that because you all never got to see Geraldine's portfolio. I did, of course. It was amazing to say the least. And she was getting a return of her original capital every 3 years just in dividends alone. Wild, wild, wild. Anyway, so I wasn't really shocked to see that. Capital gains, the totals. So 52,000 went into it. You had $121,000 of dividends and capital gains that were taken out. And at the end, the fair market portfolio value was still $103,000. So the total return on investment was $224,000. This was putting $1,000 into each name. $1,000. And that was the return on $1,000 from inception in mid-August 2006 to December 31st of 2024. Then he went crazy. He went nuts. And he just wanted to see how did the Timely 10 compare to the S&P and the Lucky 13 from inception through December of last year. And as you go down on the left side, you can see the return each year of all three portfolios. What's in blue at the very bottom? So yeah, this was a $10,000 investment every year. Timely 10, 68,000, S&P 59, Lucky 13, 49. Now, if you go back to when we started the Lucky 13, it outperforms the S&P by about 4%. And that's on the compounded average return. 4% compounded annually over the S&P is pretty phenomenal. And then with his amazing detail, you can see on the far right of the chart everything that happened during those years. And like I said, I never kept track of this stuff. I had no idea that the Timely 10, which, as I said at the beginning, was not ever supposed to be a standalone portfolio. It was just to show you guys the process and how we go about picking stocks. It never entered my mind to say, hey, this is a standalone portfolio, because 10 stocks is just not enough. Anyway, I thought that was pretty impressive. And for every year, he did an entire spreadsheet for the return so that he could prove the work and go back. So this, for example, is his spreadsheet for 2024. And if you remember on the prior slide, at the very bottom, 12.65%. How did he get there? This is how he got there. So, in other words, he did the work. He was honest about it. Didn't fudge. Very detailed, very scientific. Totally blew my mind. Anyway, I wanted to share this with you guys. The internal rate of return from inception, which you see down here at the very bottom, is 12.47%. That's about a little over a point better than the Lucky 13. And once again, you can see all the work and how this was all compiled and put together. And of course, he gave me these really great notes. First 5 years was never out of pocket more than $52,000. The remaining 13 years took out 173, almost 174,000. After 18 years, he still held 70 securities in the portfolio worth 103. So there you see his net proceeds. And then I really got a kick out of this. The average dividend yield in the remaining portfolio went from 3.3% to 4.6%. What does that speak to? It speaks to our companies raise, on average, continue to raise their dividends every year. So when you hold something for an extended period of time, your yield, your return on investment is going up on a dividend basis. We already talked about this. The compound annual return for the 18-year period is 12.5%. And then I found this interesting. The 88 overvalued securities sold were held for an average of 5.5 years. Those 88 overvalued securities provided 180.2% and 156% returns when including and excluding dividends. Amazing detail. Overall, the Timely 10 outperformed both the S&P and the Lucky 13. And all of this occurred despite the real estate mortgage meltdown, quantitative easing, the pandemic, bank failures, yada, 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 yada. And as he put at the bottom, all of this is based on investing $1,000 per stock. Imagine the possibilities if we invested $5,000, $10,000 or more. Now, this is where I have to say, past results are not a guarantee of the future. If I don't say something like that, some guy from the SEC is going to show up and I'm going to be in all kinds of trouble. But it's pretty consistent over the last 18 years. Okay. And if you go back, and I'm assuming a lot of you will download this presentation and you'll get to take a look at these spreadsheets and see how this was done. And I know some of my readers who have also become my friends who are engineering oriented are probably going to want the S&P sheets. And so anyway, there you can see how to construct them. And then I'm just on this. I'm going to end on this part, and then we'll go to your Q&A. You know, the baby blues is something we started. I think what was it, 2021? Yeah, somewhere mid-year 2021, something like that. And what's the difference? The baby blues is the same criteria for the select blues, except only 15 years of uninterrupted dividends instead of 25. This is something that Geraldine and I talked about doing years ago. Jerry would say, honey, I wonder if we did this. I'd be curious how it looked. And, you know, we talked about it. We never really got around to doing it. And then I know a lot of you have read both of my daughters have interned for me at one time or another. My younger daughter, Jillian, who's number 3 out of the 5, interned for me the longest. And so one day I gave her a project and I said, hey, I want you to do X. And that's how the baby blues came into fruition, was Jillian did the work. Of course, I went back and I checked everything and it was like, dang, I wish this girl was interested in the stock market, but she interned for me because she loves me and I'm her dad. And I paid her tuition, you know. So anyway, same process that he did with the Timely 10. And I just thought I would just show you this down here in the bottom right corner. From inception through the end of December, he had a 17.66 annualized rate of return. And so the point that I really wanted to make was our process of what we do. It covers different time frames. It covers different criteria, whether it's the Timely 10, the Lucky 13, the Baby Blues. The process works. And that's the point, and that's why I wanted to show that stuff to you guys. So I think, yeah, that was it on the PowerPoint. So let me get rid of that. And here we go. I'll open up the chat room so I can see. Yeah, I think everyone got muted. Okay. So anything that you guys want to ask? I've got like another hour or so. So, you know, let me know what's on your mind. And, you know, I'll try to answer it to the best of my ability. How do we get that presentation? It is being recorded into the cloud, and then Elena is going to go and she's going to get it and she's going to put it on the website. Yeah.
Kelley, could I ask how much cash is good to have? What percentage you think of your portfolio should you have in cash at this time, or should you be fully invested? What's, you know, I just
Well,
want.
there's the general, what I call the general rule, which is traditionally I would usually hold somewhere 5, 6, 7, 8% in cash.
Wow, that's all.
And then there's the reacting to the current environment rule, which is if I don't have anywhere to put it, meaning let's say I've got a hole in a portfolio in a sector or sectors, and I can't find anything in the undervalued category that's like one of those ones or twos, I'll put it in, you know, some kind of, usually a treasury money market, something like that. And so I think some of the portfolios that I run, some of the folios, I think have like 35% cash in them, something like that, 35, 40%, because I can't build them out between 25 and 30 stocks the way that I want to. So I'm not going to get bullied. Um, yeah, I'm not going to get bullied
But
into buying something just to be buying something.
couldn't you just put them in the stocks that you have that are doing well? Just keep adding to those, and then if when you find something you have when you find something to fill one of those holes, sell it. I mean, what would be it?
Yeah, I guess in theory, if I hope everyone can hear that. I guess in theory I could do that. I'd like to maintain my diversification because that protects me and it protects the portfolio. And then people say, well, the timely 10 is concentrated. And I say, well, yeah, but it's not meant to be a standalone portfolio. And they say, well, the lucky 13 is concentrated. Um, yeah. Um,
What
But the Lucky 13 also was just supposed to give you guys a something to build off of to get to your 25 or 30 stocks, you know. So um,
Well, aren't most stocks diversified in their self? I mean, most stocks kind of are diversified, aren't they?
are most
I
stocks
mean,
diversified? Well, they do what they do. Um,
they seem to do everything, in
but
my
I like
opinion.
to, well, the conglomerates are involved in a lot of different things. But yeah, yeah, I mean, I like to own 2 to 3 stocks in each of the 10 categories, and that's how we get between 25 and 30. And it's just diversification is your friend. Hang on here. Let me see. Let me, uh, Dow Inc. What do we do
Mm,
with our holding? A big loss.
miserable,
Yeah,
yeah.
yeah. Dow Inc. is stinking it up. Um, they're in a world of hurt. They're going to be in a world of hurt for a while. I would tell you this: if you're holding it in a taxable portfolio, sell it and use it to offset a gain. If you're in a qualified portfolio, that's not going to do you any good. I mean, if you're like in an IRA or 401k or something like that, that won't do you any good. Sometimes, as much as I hate it, you just have to bite the bullet, and that's the price of admission, and we call it a day, and you let it go because, yeah, Dow is stinking it up. So I know that that's not, you know, what you really want to hear, but that is what it is. Um, is it possible to get the Excel working for the work which was done for the timely 10? Good question. I only have the slide. I'll ask Keith if he's willing to share that with the community. Um, Otherwise, I can probably look at the slide and recreate it. And I want to do that like I want to shove a knitting needle through my head. But anyway, I'll find out about that, uh, Sandeep, and I'll get back to you on it. Do you automatically reinvest your dividends? I don't, because I want to handle the cash. I mean, um, if I want to buy more shares of that stock, if it's in the undervalued category, great. If I want to use that cash to buy something else, then great. Um, if you want to do a DRIP, which is a dividend reinvestment plan, they're fine. It's just that once you get into the rising trend, I would turn it off, because then you're reinvesting dividends not at the undervalued area, which is, the point of our process is to buy stocks at that low price, high yield area. Um, on the timely 10, $1,000 purchases, if a company was a multiple timely 10s, was just the first instance purchased? Yes. Yes. Keith did not, yeah, he did not purchase it every time. Let me see. I think that the timely 10 is sector biased. Example, I cannot recall a utility or REIT in the timely 10. Makes using the timely 10 to create a diversified portfolio pretty hard. Yeah, I agree. It's not biased though. I mean, if you watch that part of the presentation, I've got a ranking system based on dividing the universe up into quintiles. Top 20%, next 20%, third 20%, yada, yada, yada. And I only take stocks primarily out of those first two quintiles. So on publishing day, I pull up the list, and whatever those 10 highest ranked stocks are in terms of return on invested capital, free cash flow, and price divided by economic book value, that's your timely 10. There's no subjectivity to it. It's just numbers. I take the top 10 numbers, but that's really good information for you though. And here's what that information is those well, there's been a utility. There's been utility in there before. I think UGI Corp was at one point. But the fact that there's no utilities or REITs in it right now will tell you that their cash flow internals are not in the top two quintiles of our universe in terms of cash flow. That's the point. You want the best of the best of the best. I mean, if you look at the timely 10, that's 10 stocks out of 4,300. That's like 0.20% of the market. And remember that the timely 10 was not supposed to be a standalone diversified portfolio. But things change. Trust me, this market will change. And one day you're going to see a bunch of utilities and REITs in the timely 10 because they will be in those top two quintiles. Okay. Can you explain how the process works for companies undergoing significant transformations? For example, Regal Rexnord, it has spun out so many business lines that its dividend history becomes opaque. Well, as I wrote, I think in the last issue and in previous issues, we have an algorithm that takes a look at the dividend yield pattern, and as the dividend pattern changes for a company, our algorithm will adjust and modify for it. So it's not something I can say, oh, Regal has dumped this, dumped this, dumped that, and now they own this and they own that. And so basically, until the system tells me, hey, look, there's a change in the company, we're not going to change the profile on it. And ultimately, who makes the decision on the change is you and the millions of your peers that you don't know who are making buying and selling decisions on these stocks on a daily basis, because that's what the algorithm tracks. It tracks the buying habits of everybody in a specific stock. It's a behavioral thing. So yeah, is this a blind spot in our process? Maybe. I have to wait for the data to change in order to make a change, in the profile. So I'm kind of dependent on all the market participants deciding what they think about the changes to the company before that we can detect a change in its dividend yield pattern. So probably doesn't give you the answer that you were looking for, but it's the most honest thing that I can tell you. What did I miss on Rite Aid? It's a good question. Yeah, Rite Aid's defunct now, aren't they? Yeah, it happens. Sometimes we can see it by looking at the cash flow parameters in the spreadsheet. When you see return on invested capital and free cash flow starting to drop, that tells you something's happening with the cash flow of the company. And if it gets bad enough, then that tells you, wow, this company's in trouble. We stopped following Rite Aid a long time ago, and I forget why. It's been so long, I don't remember why. But I'll have to go take a look. And who asked me that? Stanley. Stanley, I'll
Yeah,
see. Yeah. All right.
I must have bought it when you were still following it.
Yeah. Well, if we stopped following it, it's because they no longer met our criteria.
Do you, just out of curiosity, which gets me to my ultimately question, do you have anything in the newsletter? You got like the faded blue chips. You have something, okay, we've stopped following this, be alert, or something. There's a short blurb. You ever thought about putting that in? Something like that?
Well, we kind of do it like this. If you're looking in the select blues and you've been following something and you don't see it there, I now produce the faded blues in every issue. You go down and look at the faded blues, and if you see something highlighted, then it's a new entry. If it's highlighted and bolded, if it's bolded and italicized, it was a new entry in the previous issue. So yeah, other than that, I don't have a lot of room, although sometimes depending on the layout, and one of Elena's cartoons, we can put in what's called the blue chip info notes, which is usually what I do when there's additions and subtractions and changes between categories. Okay, I'm going to address the ETF kind of towards the end. Are the stocks in IQT extremely valued? The overvalued ones are. The declining trends were, but they're now starting to fall off. The rising trends that are less than 50%, and they're rising trends, they're not extremely valued. And the undervalued is not extremely valued, but the broad market is. And yeah, we only play in a small subset of the market now. So is it Niels? Niles? Okay. But that's the point of what we do. Even if the broad market is overvalued, we can look at undervalued stocks. And, if there is a major correction or a major bear market, our stock's going to decline initially, probably in the first week, 2 weeks, something like that, because it's an emotional reaction. When they pull the plug in the bottom of the bathtub, everything floats down. But as soon as that emotion is addressed, then cooler heads prevail. And because our stocks are high quality, and because we know where the undervalued area is, they tend to recover first and fastest, and then take off and go on. So yeah, the market it's the most overvalued market in history, period.
I have a question on that bullet, Kelley.
Yeah.
That was Keith here, different Keith than the Keith that's been doing great work for you. Extremely valued broad market. And initially I thought on that, and it's like, but we don't have to worry about that if we just buy from the undervalued category, right?
Right.
The stocks that we buy. So, but I'm trying to still use that point for some value here. You talked about some of your portfolios having up to 35% cash. I'm in the 28% range. So I have a fair amount of cash, and I'm kind of doing a drip system of just buying something with that cash once a month. I'm reading that as there could be some opportunities forward, and I should sit on more cash right now. Is that how should I'm always going to select from undervalued, usually from the timely 10 or something that's rated a 1 or
Yeah.
2 on your rating scale. But I just wondered how I should use that with the IQT model here. That point.
So the way that I would answer that is this. Even though the broad market is at the most extreme valuations in history, if I was putting together a portfolio and I could find 25 to 30 stocks in the undervalued category as equally diversified as possible that were in those top 2 quintiles of our cash flow tracking, I put it together right now. Boom. Skippity doo dah, no problem. I would have no qualms about doing it. The fact is, though, even though there's 89 stocks in the undervalued category, there's some categories. I mean, there's some sectors that are not really present, and those that are not in the cash flow area that we want. So I understand your question in the broad sense. Historically, I would say if you can't put together your 25 to 30 stock portfolio because the stocks just aren't there, yeah, stick around. Um, they'll show up by one reason or another. I get it. I get your question because I used to talk to Geraldine all about it all the time, and she would say, "Honey, stocks are like streetcars. Another one will come along soon." Which is was her motherly wisdom. Um, don't force it. Don't force it. I mean, I know you look at that 28% cash and you're going, I
Yeah.
missed, I'm missing something. No, not necessarily. What you might be missing is a trap, you know? So that's how I would address that.
Thank you, sir.
Uh, sure. What do we got going here? Texas Instruments. Yeah, Texas Instruments. I don't I don't think let me pull this up real quick. I'm gonna do this off screen. You guys aren't gonna see it. But just hang on a second. I'm looking at my spreadsheet. So there we go. Texas Instruments. Okay, return on invested capital 15%. Great. Great. That's good. Free cash flow yield 1%. That stinks. That stinks. So that means they're either burning cash, which, well, that's it. They're probably burning cash. That's why their free cash flow is only 1%. But their price divided by their economic book value is 4.0. So that means their price is 4 times their economic book value. Yeah. So the market has already built in a lot of something into Texas Instruments. And the underlying cash flow just doesn't really justify it right now. Just being straight up with you. I I struggle selling an overvalued stock when the cash flow internals are still looking great. Yeah, I gotcha. I feel your pain. I understand, Steve. So, here's the deal. Um, this stock has, if it's in the overvalued area, you have already gone to the historically repetitive area of high price and low yield. Which is why its cash flow internals are good. It's a confirmation. Company's killing it, you know. They're generating. They've got growth. They got cash flow, and but they are at an area where historically they've started to roll over. So, I'm not a huge advocate of using trailing stops. I'm not a huge advocate of stops. That's because the guys on the floor have got these electronic books and they see where all the stops are. And occasionally they'll just make a run and they'll push the price down until they hit all the stops and they take everybody out and then they go back in and buy the stock again. So, um, but um, if you got the 80% in the middle, Steve, historically, man, you've planted the flag, declare victory. Um, and don't be afraid. I mean, I just showed you this process works. The process works over a very long time. We've been doing this since 1966. Um, you'll find another. You'll look. This is what we do. This is our reason for being in existence. It's to find these companies and to find out when they offer good value. Um, you'll find another one. And I get it. I get it. Look, when I sold McDonald's, I'd held that stock for 16 years. Bought it at 15, 17, and 19, and we sold it for, I don't know, what was it, $370, something like that. Broke my heart. 4 months later, COVID kicked in. And the market crashed. And yeah, so that's the reality that happens. There's a reason why we track undervalue and overvalue. And if you catch that 80% in the middle, good for you. Congratulations. Don't worry about not ever being able to find another stock because you will. I hope that helps. Fact set. That's a baby blue. Blah, 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 blah. Colin, I don't know off the top of my head. I'm going to make a note. And I'll go take a look at FactSet and I'll send you an email and see what I find out about it. Would it be possible to identify drip stocks in the newsletter or a column in the associated Excel? I'm not sure, Dan. I'm not entirely sure what you're asking. I mean, in most stocks that pay dividends, their company offers a drip program. So that's just a matter of contacting the company and then seeing what you need to do to get involved. Although most of the brokers now will automatically reinvest for you. You just got to tell them when to turn it off. So yeah. Yeah, I don't know how much more to respond to that. I've already got so many bloody columns in the spreadsheet. I mean, it's starting to get unwieldy. But if I didn't address it, Dan, send me an email, Kelley at IQ Trends, and we'll flesh it out. Okay. Comerica merger with Fifth Third Bank. Should we hold? It's a great question. Let's look, shall we? Comerica. Boy, it was right at undervalued. And Fifth Third was in a rising trend, but only 12% into its rising trend. That's going to be a nice little bank. Yeah, you got no reason to sell it right now, Lynette. I hope that helps. Okay, George, I kind of just addressed Comerica. iPhone 56 says there have been REITs in the timely 10. Okay, all right. Have you ever looked at the average life cycle of an elite blue chip from first inception to becoming a faded blue? Are there still? Yeah, there's a bunch of stocks that are still in our universe from when Geraldine was still running the company. We at one time had done some kind of a study, and I remember what it was. There's a buddy of mine who ran a mutual fund, and he did some kind of a survey, and he said that our average from undervalue to overvalue, the average was 3.5 years was the median, which means so half of them went from undervalue to overvalue in less than 3.5 years, and then some of them took longer. I know back in the day there were some sectors that had really long cycles. At one point, pharmaceuticals, it was like had a 9-year cycle, taking them from undervalue to overvalue. I don't know if it's still like that or not. I have to go take a look at it. Ooh. Would you sell a rising trend stock in a particular sector for a stock that has better internals? Wow, that's really interesting. Probably not. If they're in the same sector, I might add the new one. You know, Benjamin Graham taught us that every time you do a transaction, you got a 50-50 chance of doing something monumentally stupid. So he said, when you get a great company, don't be in such a bloody hurry to get rid of it. So that one, Steve, is kind of subjective. I would have to have a really, really, really like compelling story. I mean, it would have to literally be a no-brainer for me. So like if I owned well, I was gonna say if I owned a restaurant stock that was in its rising trend and undervalue and McDonald's fell into undervalue, and all of its internals were in the top 2 quintiles, yeah, I might do that. But that's an unusual situation. Robert Half International, RHI. Let's look. All right. So Yeah, the market took it out and shot it. Why? Because it's a human resource and employment services company. That's the market telling you that they think we're going to go into a recession. Interestingly, though, the return on invested capital is 9%. That's not hideous. The free cash flow is still 4%. So that's okay. And they've got a capital G, and they're way, way, way under. So the market's got them priced kind of as if they're going to cut their dividend. But if you look at their cash flow, there's no reason to cut their dividend. I would probably go ahead and hold on to that for the time being. Okay, Betty, what is the order of value of an undervalued company using the spreadsheets with each publication? Well, the last one, price divided by economic book value, that tells you an awful lot about the company. If the price divided by economic book value is less than 1, you're buying a stock. You're paying less than $1 for $1 worth of assets. Let me just put it that way. And then I would look at the return on invested capital. So I hope that helps. Yeah, that's the way I has a that's the way I go about it. Home Depot has a target price of $500. So what is that overvalued? Jeez Louise. Let's look.
Yes. That is
That's
the
Home Depot is overvalued at 526.
that's what you got in the newsletter. That's what it calculates to be.
Yeah, that's the theoretical overvalue based on that. So what do we got? Boy, it's right smack dab, man. This stock is at equilibrium. It's got
got the $420 just a month ago.
yeah, so you've got 23% above undervalue. So it's a quarter of the way in its rising trend, but it's only 29% from overvalue. Wow. So
When do you declare it?
here's the rule. Here's the rule. When you get within 10% of the overvalued area, okay, you're kind of in your kill zone right there.
Okay.
So
That's what I thought. Yeah, I think you've
that
written that before.
yeah, what would that get you around 475, something like that?
Yeah. It didn't quite get there. It was close.
Yeah, well, hey, I've seen stocks, they'll go right up and then they'll not quite get into overvalue and they'll stair step down a little bit and then they'll, yeah, that happens. All right. Taiwan Semiconductor. So Texas Instruments and Taiwan Semi have invested a lot of cash in facilities. Yeah, they have, which has hurt their free cash flow. Yeah, that's what free cash flow is for, though, is to invest in opportunities which will generate future profits. Hopefully the free cash flow will pick up when the CapEx starts generating cash flow. Yeah, that's the point. Yeah, you spend your cash flow you invest it in order to generate future profits. And then when that happens, then you're going to get more free cash flow. So yeah, that's the process. So yeah, Colin, you're right on. So let's see. Is the long-term debt column at debt to equity weight? It's long-term debt to equity. That's what it is long-term debt to equity. Yes. Randy, are the stock rating quintiles ones and twos used for the timely 10 published anywhere? And the answer is no. I mean, I have access to them, but no. And I don't, yeah, I'm not going to muddy the waters by putting those in. But yeah, no, they're not published anywhere. So let's see here. All right. So how does a stock like Texas Instruments with dividend danger find its way into the timely 10? Dividend in danger. So in that part of the newsletter, those numbers are the gap numbers. So based on gap, their trailing 12 months earnings is less than their current dividend. But if you look at their cash flow, you see that, oh, no, their cash flow is fine. But Texas Instruments hasn't been in a long time, but I get the point of your question. So yeah, can a dividend in danger stock make it in the timely 10? Yeah, if it's got a green X, that means its cash flows are more than sufficient to cover its dividend, and it's only dividend in danger because of gap accounting, which is an abomination to mankind. But that's just my personal opinion. Let's see. All right, so you guys are interested in the survey that went out. All right. So I'm talking with another concern. And we are talking about doing something together, and it would be along the lines of an ETF. And I can't talk too much about the particulars, but the reason why I surveyed you guys was it's ETFs, promoters, sponsors. It's kind of funny. I've been approached on 4 separate occasions that said, we want to do an IQ Trends ETF. It's like, okay, praise God. Sure, I'll do it. Yeah, I'm into it. And then can you provide us with blah, 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 blah. Most of it is performance and mechanical and process and stuff like that. Because all this stuff has to go into a prospectus at some point. And then you get down to brass tacks, and in the first 3 or 4 times, what's happened is the sponsors have come back and said, "Kai, that there's the dividend aristocrats and there's the dividend kings, and those are really well-known names, and they're better known than IQ Trends, and so we don't know if we really want to try and compete against that. So if we did this, where's the first $500 million going to come from?" And I'm like, well, hang on a second. I've got the process. I've got the track record. Isn't that what you're supposed to do? Is the marketing and whatnot? And so what it comes down to is the sponsors will come to you and say, we would love to do an ETF based on what you guys do. but you have to show us that there's an indication of interest. So that's why I sent out the survey. Now, am I a fan of ETFs? No, because I think I can outperform them, and beat them. One thing I've learned though is that some of you folks are more seasoned than others, and you're getting tired of the work it takes to do individual stocks. And so I get these emails or letters from you that say, Kelley, we've been with you for 15, 20 years and love it. You've helped us do this and blah, 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 blah. But you know what? We're just tired and we don't want to fool with it anymore. And so we're going to turn everything over to an investment advisor. And then I've gotten letters and emails and phone calls from these folks who've said, yeah, this guy took the portfolio that I had put together over so many years and took an axe to it and destroyed it, and then put me in a bunch of mutual funds and stuff, and now I'm losing money. So, which I feel, I hate to read and hear stuff like that. And then the younger demographic says, they've been very conditioned, to buy ETFs and mutual funds. And it's probably because their first investing experience was with their employer, and they go to HR and HR says, okay, we've got a 401k. And they say, well, what do I invest in? Well, here's the plan. You've got all these choices, just pick them and put them in. And so, they're kind of used to that. And plus, Wall Street's done a hell of a job telling people that passive investments are more perform better than actively managed investments, which I've got some results where I beg to differ. But anyway, that's what it is. So I'm thinking, all right, for the younger demographic, this is a way to at least keep them from blowing their hands off because they don't have enough life experience and investing experience. And for my seasoned folks, I hate to see you go because you're getting tired and you don't want to fool with it anymore. So that's the only reason why I would really do an ETF. It's not that I just woke up one day and said I wanted to do it, but I basically want to do it for my community. And just to be honest, yeah, there's a little piece of me where I would love to kick the institutions right square in the butt and go nee, 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 nee. But anyway, that's just me. So that's the reason why we did the survey. I wanted to get an indication of interest to see if you guys, number one, would even be interested in something like that. And then I have a few other groups I'm talking to so that we can go and say, yeah, we think that we have enough of an interest that, yeah, we can bring the capital to the table and make this happen, because you need a certain amount of capital because there's stuff that has to be paid for, and so you have to have the money to invest in the stocks, but also, to pay all the fees and do the lawyers and the CPAs and all that stuff. So anyway, it's a work in progress. I didn't mean to take you over the hills and through the woods, but it's a work in progress. And so that was the reason for the survey, and that's where we're at with it right now. So I hope that answers that. uh, Woody Allen said a money manager is someone who manages your money until it's all gone. That's funny. Thank you, Alan. I appreciate that. Let me see.
Kelley, don't you also manage money? You
Yeah.
manage portfolios? Okay.
Yeah. I don't talk about it. We're really right about it. If you've been around for a while, we do it. Yeah, I have some peers that do it as well. Peers that publish newsletters, and then they also manage money, but the SEC in the state of California doesn't like you talking too much about it. And God forbid you irritate the SEC or the state of California, because they can make your life miserable. You know, a couple of years ago, I went through an audit with the state of California. I'll just be straight up with you. Lasted over a year.
Oh my gosh.
Oh yeah, lasted over a year. Yeah. If I never have to do that again, it will be too soon. So anyway, blah 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 blah. Let's see. Anything else here in the chat room? Present company not included, the Woody Allen comment for sure. That's nice. Thank you. I appreciate that, Alan. Yeah, Stanley, I got you. Nice. Yeah, Colin, I made a note. I'm going to get back to you on FDS. Stanley, I'll get back to you on Rite Aid. Thank you, sir. Ernesto, appreciate it. So anybody else got anything they want to ask? They want me to cover?
How about Amphenol?
Who?
Amphenol?
Is that in the baby blues?
Yes. It's just going crazy, but they make fiber cables, I think, fiber optic.
Oh, well, then that's what you need to know. Let's see. Amphenol Corp, capital G, they're overvalued. Oh, God. They're 32% over their overvalued area. 21% return on invested capital, zero cash flow. Wow, they're burning cash like crazy. And their price divided by economic value is 6. So they are 6 times their economic book value.
Sell it, keep it.
If you want to live dangerously, at minimum, you should probably pull up a chart of it. Pull up a chart. I guess I could produce one. And what you want to do is you want to go find the most recent low. The most recent low price.
It's probably
the most recent major low.
okay.
Okay, the most recent major low. Yeah, that's important. And then put a stop in below that. Because if you put a stop at the low, you might get caught in one of those situations where they make a run and they take out. This is horrible. Don't hold this against me. But there was a term we used to use back in the day. We called it the weak sisters, where they take out the weak sisters. And that's everyone that had stops. Boom, 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 boom. So, yeah, you want to look at the most recent major low. And if you're going to use a stop, put your stop in below that. And then you can at least protect yourself, because, I mean, this thing's 32% above its historically repetitive area of overvalue. My God, if that doesn't tell you we're in a bubble, nothing does. That's wow.
Hey,
Let me
Kelley?
see. Yo,
Yeah, if you have time, I'm real light on financials, and I've been shopping for a financial while I've been enjoying your conference. What do you think about People's Bank Corp? I'm looking at your spreadsheet and I'm liking the numbers.
yeah, didn't I just write them up? I think.
You might have. That's usually my next step, is to go through all your newsletters I've saved to find out when you wrote People's Bank Corp.
Yeah, I think I just, let me pull that up. I think I just wrote about them because undervalued,
Killer dividend.
small G. Oh yeah, they pay 5.4%. Not bad. They're at 30. Their theoretical upside is 63. So you've got a long way to go. 9, 5, and 0.7. Yeah, you got a winner. That's yeah.
Thank you
I
for
got
the tools to pick a winner.
yeah, I got absolutely no problem with that. That's not bad. That's not bad at all. Um,
And I
any
just
thoughts
caught
on
I just
any?
caught an AI generation that said top bank in 2025, People's Bank Corp, according to Forbes.
You know, I'm glad you said AI. Um,
Ooh, do I
you
ignore
just
that
no,
one?
you just reminded me something. Keith, the guy who generated all that wonderful work, he went into an AI engine and he says, "Yeah, I'm interested in stocks," and he put in our criteria, and the AI returned the answer to him and said, "Yeah, you're looking for investment quality trend."
Oh, excellent. Excellent.
I got a huge kick out of that. I was like, "Oh, okay. Well, AI is actually pretty smart." Okay.
Thanks
On
for
the
the feedback.
newsletters, yeah, on the newsletters, how do you choose the four stocks with the charts? So at the beginning of the year, um, the first, I think, first 3 or 4 issues, we do the Lucky 13. And then after that, we do all the Timely 10 that's not in the Lucky 13, but is in the undervalued. And then once I've run through all of those, I just start looking at stuff that kind of interests me, that I sort of find intriguing and go, oh, this might turn into something. Yeah. Um, and so that's it. And that's why I'm waiting for Lockheed. Lockheed keeps teasing me. It's like 12% downside left to get into the undervalued area. And so I think I wrote about Lockheed not too long ago. Um, but yeah, that's how we pick the ones we do the charts on. And uh, yeah. Any thoughts on further bank M&As? Well, these things usually happen in tandem. Um, your bigger regional banks want to get bigger. I mean, Comerica was not a small bank. So Fifth Third, man, that's pretty aggressive. I mean, not that Fifth Third is not a small bank either. That's going to be a really nice regional bank. Now, all their competitors are going to look at that, and everyone's going to get acquisitive. So, um, if your question is, do I think there will be more M&A? Yeah, absolutely, because these guys don't want to get beat out by their competitors in terms of market share and stuff like that. So yeah, you're gonna see that. Cracker Barrel. Oh my God. I knew somebody was going to ask me about this. God, it really irritates me because it was such a great company. Um, and I know that COVID was hard on them. Um, like it was hard on a lot of people. Let me see. Doon, 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 doon. Okay, so 6%, 4%, and 3.2. That 3.2 is that's concerning based on the current cash flow. It's better than it was. Um, I think their biggest problem right now is perception. I mean, because they had a certain culture, and then they had a certain demographic that they appealed to, and then they tried to do kind of a radical change. And so I think that cost them. I'll be interested to see what happens if their CEO is invited to move along and they get somebody else. That might be interesting. I hate to give up on them. I mean, I know it's horrible. I mean, I know there's some horrible losses in it. I'd like to think I'd like to think they make a comeback, but my general advice is this: if it's in a taxable account and you can use the loss, then take it. If it's in a qualified account, maybe give them a little more time and see what happens. CIX. Jim, hang on before I talk about CIX. Jim, there's something going on with your computer. Because that's not supposed to happen. What you're writing me about. Let me talk to Eric, my programmer, and then I'll send you an email or give you a call. All right, CIX. Yeah. CIX. Let's take a look. Why am I? Oh, there we go. Compex. Yeah, Compex International. Okay, it's 21% above undervalue. Capital G. Nice. 12%, 8%, 1.3. Great company. If you own it, hold it. If the Mr. Market smiles on you and it drops down to where it's only like 12% above undervalued, then I would probably go take another look at it as long as those internals stay the same. But yeah, they're killing it, man. They're growing. They got great free cash flow, and the market hasn't lost their minds on it yet. So yeah, I remember when I added it, I found it because I'm constantly doing screens. Because we're always searching for stocks. I mean, we're always searching for stocks that will, fit the criteria. And it's a treasure hunt. And it's a process to find them. But yeah, I remember when I found Compex. Yeah, I like those guys. All right. Let's see. Anybody else? Anybody else got anything? And we'll try to address it because I got like 5 minutes before Zoom kicks me out of here. So, all right. So you guys have been very nice in the chat room. I really appreciate it. Oh wait, one new. Any thoughts on 3M? Hey, 3M, man, they're doing their thing. And I think they just dropped into the declining trend, if I'm not mistaken. 3M, yeah, they just dropped into declining trend. Let's see. Yeah, I mean, they're killing it. 14%, 12%, 2.1. Yeah, that's why they went to overvalue. It's because, yeah, they're yeah, they were growing and they got great cash flow and yeah, but they're just yeah, that's why their internals are great, but they just went into a declining trend. So the
Kelly, do
rules
you have sometimes have more than 30 stocks in your portfolios?
rarely. I mean, occasionally. I don't I don't like to have more than 30. That's kind of my line
You
in the
divide
sand.
your percentage up to 100 in the 30 stocks, right? Yeah.
Well, actually Geraldine taught me this. Once you get too much past 30, you're kind of giving up the edge that you've gotten from being able to pick great companies. And so, and that's still I mean, it's still kind of a concentrated portfolio if you think about it. Only 30, I mean, if you compare it to the indices, that's still a relatively concentrated portfolio. But that's the point, is because you only want to own the best of the best. And I mean, unless just got it, and I've had this discussion with some of you. The I don't want to have that discussion with myself where I say, God, do I really want to sell this to buy that? Because it's tough. And occasionally I'll cave, and yeah, I'll buy it and own it. I am a human. I'm weak. What can I say? I try to follow the rules as close as possible. But yeah, every now and then there's something that's such a compelling buy, and I don't really want to sell anything that I have. And yeah, I'll put it in. I'll put it in, but I won't go crazy with it. I won't go crazy with it. Okay, Whirlpool. Whirlpool is a sponsor for the Professional Lacrosse League. I did not know that. Interesting. Thank you, Carl. So John asked me about Whirlpool. So um, Whirlpool is suffering its excesses successes. So during QE, when we had zero interest rates and cash was easily accessible, the consumer lost their minds. They went crazy. They went on a buying spree. And then during COVID, when your federal government decided to push $6 trillion into the economy, people said, God, look at all this free money. And so, yeah, Whirlpool was the grateful recipient of much of that. And people bought washers and dryers and dishwashers and yada, yada, yada. I mean, and Whirlpool's profits went wild. Well, the bottom line is what happened is profits from future years got pulled in to, that present time. And so now the piper is getting paid for all of that. So it's a great company. It's going to take them a while to get back to equilibrium. But if they became undervalued, I would have to look at them. Yeah, I don't have a problem with them. And now that I know that they're the sponsor for the Professional Lacrosse League, hey, you know, you got that. They got that going for them. All right, you guys. I'm gonna call it a night. I know it's 9 o'clock on the East Coast, 6 o'clock here. You guys, as always, I appreciate you. Um, Without you guys, I've got nothing to do. So we have a symbiotic relationship. We need each other. So I really appreciate it. This is being recorded on the cloud, and Elena will get it up on the website. And yeah, by the way, all those graphics, I know some of you say, can you cool it on the color? But I just happen to have like the greatest graphics designer in the world, and her work is gorgeous. So I'm gonna give her that. You guys are great. Thank you so much. Have a great night.
Thank you, Kelley.
All righty. All right. And how do I get out of here now? Oh, there we go.